Up on stage. Our Bridge Plus member, Bonnie Value, will be leading a panel discussion on the recent trends in bond markets and what's coming up for 2022. Oh, sure, of course. This panel will be made of heavyweights. Ms. Oi E. Chu, Chief Commercial Officer at ADDX, Mr. Rajiv Tumala, Director of the Digital and Data Team, Markets and Security Services at HSBC, and Mr. Adam A. Cowperthwaite, Managing Director, Head of Capital Markets Asia Pacific City Private Bank, who will be joining us virtually. The panel will be moderated by Dr. Rahul Banerjee, co-founder and CEO of Bonnie Value. Now let's all put our hands together to welcome the panel up on stage. Thank you.
Hello. Adam. Thank you, Minji. We'll just wait for Adam to come on screen. Huh? Are we mask on? Okay.
Oh,
awesome. Warm hello to everyone virtually. I think we have about 150 people there. But before I do the introductions, I just want to wait to see if Adam's online. I'm sorry? Okay. I'd rather wait. I think we're a few minutes early, right? We are 4 minutes early.
Questions.
Shall I make some random jokes or something? But I think one thing that we were discussing was that this panel is going to be about more market structure and what's structurally wrong with the bond markets. Now the three panelists are trying to solve it rather than investing tips on whether to buy China Evergrande or not. So that's a clarification.
Oh, where will Bitcoin be in 2 months?
Where will Bitcoin be?
Hi, everyone. This is Minty from Bridge Plus again. Thank you for your time. I think we realized that I have a little bit of time before the next panel. So right now, I've actually already asked Ms. Pauline Ray from BCG. And if you have any questions from the ground, whether from the participants here in Bridge Plus or those of you who are joining us virtually, please feel free to write in your questions and we can ask the speakers, whether it's Ms. Pauline Ray or whether it's our speakers here as well. I think let's make use of this time. The speakers are all very busy people. So now the fact that they're all here with us, it's a perfect opportunity for you guys to fire away with your questions. So keep them coming in once you if you do have any questions. Thank you.
I have a question for Pauline.
I'll pass her the mic.
Since we're at it. I didn't manage to catch all your slides, but what I'd be very interested to hear is maybe specifically in APAC, even within the FinTech space, there's obviously payments, capital markets, wealth management. Where do you see the funding go to today? What's the latest sort of hot trend?
Yeah, so yep. So there's obviously, I think trading on investments has been massive in the region, right? Not just yourselves, but also in Indonesia, right? We've seen quite a number of players, and this is Southeast Asia mainly, right? And then after, what we've seen is payment players. There's quite a lot of equity capital going into the space as well. But trading on investments, fundamentally, I think that's been one of the biggest ones.
Do you see blockchain, DLT playing a big part of that?
Yeah, good question. So I think after this week, I would say yes. Honestly, I think all of a sudden it's become really, as you know, there's been a lot of people building, with blockchain technology over the last 5 years, right? And we had a bit of crazy upward and then downwards in 2017. But I think now we have a lot of use cases that have been developed, and especially because, if you want to generate value, the internet of value, and like I mentioned, every company is going to be a fintech company, not because of becoming a fintech, but there's so much revenue that's going to be derived from financial services. And when you're building, through blockchain technology, if you want to say, for example, NFTs, if you want to, generate revenue from that, you're going to have to, build from that. So I think yes, to answer your question.
Thank you.
Just to add, so on the blockchain side, right? So trading and investment, there's always a local version, right? There's always a localized version of that particular theme because you have accessibility barriers. You can only invest in your local market through your local players. So there's always play to invest. As it comes to blockchain, infrastructure is global. So I think we'll find more interestingly, the infrastructure companies coming in from the developed world. The applications on top might again be localized, and they might go back in the way of trading and investment. But right now, I think the infrastructure side of the blockchain is suddenly attracting a lot of equity investments. And that, I think, there's still scope, right? And then I don't think that infrastructure side is going to be localized as much as the application side.
Yeah, I mean, you're seeing exactly. You're seeing companies like Consensus, right? Consensus. There's so many different use cases that they're providing that infrastructure for, and they've actually they're very transparent actually with the amount of verticals, industry verticals that they're currently supplying for. So I think
infrastructure investments means that some sectors in the early stages of development as well. So that's what at least it portends, right? So that there's a lot more headspace there.
Yeah, we're seeing a little bit of that. I mean, self-servingly, we just announced, well, actually, let me take that back. Tokai just announced that they've got FSA approval to distribute product using the ADEX platform back into Japan. So I think that these global infrastructure players are also being innovative about how these cross-border ideas are going to be generated, and maybe taking the localization and globalization and just turning it completely on its head.
Yeah, and I think the other piece that's really interesting, and we might have missed it because we had so many announcements this week, is that I don't know if you heard that next year the Singapore FinTech Festival will be sort of co-located or be in different locations, of which Zug, outside of Zurich, the crypto valley. This is super exciting, right? What does that tell you? So yeah, let's see.
And it's at a good time of the year,
It's an
June
amazing
and
time. I'm gonna be there for sure.
yes.
I'm actually from that area. So
Oh,
so
really? Yeah, because in November it's too cold. June is perfect.
February skiing or the summer hiking.
Yes. Okay. Hi, Adam. Just a quick check. You can hear us?
I can hear you. Yes. Can you hear me?
We need a little more volume on for Adam. Dennis. Okay. Good afternoon, Adam. Good afternoon, everyone. Thank you for joining in this panel where we discuss the future of bond markets, right? And I have three people who I've known for a very, very long time. Rajiv, who's from HSBC, Oi and I used to be colleagues at Citi, and then Nomura, and Adam Koptowit, who I actually used to work for. So he's one of the greatest bosses I had, with immense knowledge aggregated amongst the three of them. And this is my chance to ask them questions, which is a rare one. So I plan to make full use of it. But before I go, may I just ask all introduce yourself a little more completely? Adam, could we start with you?
Yes, an introduction. So I've been in the industry since 1996. I've done a range of different things. Actually, the largest part of my career was spent as an equity derivative structurer, salesperson and sales manager. I moved into the private bank now about 7.5 years ago. And now I look after our market-facing investments for the private bank in Asia. Everything from the execution services we do through to our structured products, through to our strategic solutions.
Thank you, Adam. Rajiv?
Thanks, Rahul. I'm Rajiv Tumala. Been in the financial services industry for about 20 odd years. I've always been in the boiler room. So I'm a technologist. I come from technology, and I've always been building systems, primarily for financial services, markets and security services. And within, I have a specific affinity for post-trade infrastructure. So again, that is like a boiler room inside a boiler room. So I've been quite well versed with the flows there. At HSBC, I look after our digital product, digitizing especially the traditional security services business that is operationally intensive, and primarily look into the distributed ledger technology and how it impacts the value chain that we are in, whether we need to go, front or back, or how does our business change. That's an area of immense interest. And again, HSBC is a large fixed income player. That's where the bonds angle comes in.
Yeah, thank you. And you actually worked in places like Broadridge, which were, and even at HSBC, and I'll ask you about that, about the entire DLT implementation, security services. Oi, last but definitely not the least.
No, not at all. I'm not a bond expert. Although I've been in capital markets and investment banking for the last 2 decades, it's very much focused on the IPO side, so the equity side. But obviously with Rahul at Nomura, we did quite a lot of the sort of thinking around financing and structured finance. And of course, now with ADEX, the good thing, I'm the chief commercial officer of ADEX, and we built our platform using blockchain. So we were very fortunate to build a platform from scratch. And when we thought about doing that in 2017, obviously blockchain presented one of the best solutions we have out there in the space today. We started off thinking about democratizing private markets for high net worth investors. But what it's also shown is that because we've built a platform from scratch, we're seeing a lot of different concepts around efficiencies, or inefficiencies in the capital markets, and actually how DLT platforms are solving them today. So back to you, Rahul.
Thank you. The way I wanted to run the panel is, I'm going to start off with what's wrong with fixed income markets, right? What is the problem that the world is trying to solve? And then we go into how we can change it. So my first question to the panel is, equities are so easy to buy. I can buy them on my handphone. I can buy them on the go. FX, when I started dealing rooms, we used to scream and shout for FX prices. Today, it's all gone quiet. It's all electronic. But why is bond trading and bond investment, just from an individual investor perspective, why are we stuck? What's so hard about this?
So if you look at, right, so rather than primarily saying what is wrong with the bond market, I mean, the question probably, Rahul, is why are bond markets not accessible? And maybe that sort of gives us a different frame to look at the bond market, right? So traditionally, bond markets have never been marketed as a retail-friendly product. And hence, if a retail investor wanted to have exposure to bond, there were other revenues, right? And the competing guaranteed yield product was a typical fixed deposit, right? If I'm a retail investor and then, in a high interest rate environment, you never went after like owning bonds, or you own bonds through mutual funds or, some kind of a fund construct. And that meant that, there was no demand for low ticket size, right? Equities markets thrives because there has always been a low value, high volume concept. And that sort of meant you got to have throughput, then you have to basically have people who give you liquidity. But it's always been fascinating that the bond market was never a retail. And hence, I think all of the inefficiencies are because of that. That's basically my take. And the second and the final thing, if you look at the last 20 years, most of the innovations have basically been coming through retail demand, through the retail consumer demand. Smartphone, the need for cloud, any other new technology was driven by the retail consumers. And by not being a retail focused product, I think, the bond markets just remained as they are.
Yeah, I see it from the regulatory side as well. It's because bonds were sort of designed not for retail. If you look at even just the Singapore MAS SFA regulations around bonds, you have a minimum face value, right? Just to disallow retail to do the trading. So only accredited investors are allowed to, in theory, invest in bonds. But what's happening is also that 250,000 is also not exactly the right number for accredited investors. If you were worth 2 million net worth, you're not going to buy a single name bond. And I don't understand that. I think that this space is, if you think about private banks and how private banks are telling family offices how to deploy, portfolio allocate, have some, exposure in this. I don't see why the world is not ready to allow a fractionalization or a retailization actually of corporate bonds. Maybe not 100%, but certainly today it's very difficult to do a retail bond. You have to write a full prospectus. There's a full liability that a company takes on, worse than an IPO. Well, as bad as an IPO. But I just befuddles me at the moment why that should still be the case.
Okay. So Adam, from the panelists here in Singapore, we are hearing that reduce the minimum denom and all will be okay. Anything else, Adam? I think there are lots of other things wrong, by the way, right? On market.
The first point that I would make is that I think that one of the reasons why, if you look at the root cause of why the market is an institutional market, it's effectively because, if you want to go out and sell a bond issue, which has a limited size, the easiest way to go and do that historically has been go and sell it to institutions. You had continuous institutional demand for bonds. And as I said, you had a limited size. So really, why not have a limited audience if you knew that audience had demand anyway? So I think that actually probably is one of the main drivers, the limited size of each issue, as to why the market evolved the way that it has. In terms of, as it were, quote unquote, what's wrong with the bond market, or what's wrong with the way that the bond market operates from the point of view of somebody who would like to see broader participation, there are numerous things that I think sort of individual investors, would look for. And you can break them down as, access, transparency, liquidity, and ease of execution. And so, basically all of those things are not set up such that it makes it easy for an individual investor to buy bonds. Access, the sizes are too small. Are too large. The retail investor's size is too small to be able to buy bonds, typically. Transparency, it's much more difficult for a retail investor or an individual sized investor to go and find out what the value of bonds are, and indeed, actually even to find out information about the range of bonds that might be available. By comparison, equities, they can look in the newspaper and they can see equity prices, or at least they can see closing prices. And these days, a ton of apps will give you, streaming prices and whatever else. Liquidity is another one. It's much more difficult to see what the liquidity is for a bond for an individual investor. And then, you get that ease of access then is a result of all of those other things. Essentially, individual investors would like to be able to pick up their smartphone and buy something, as they do with equities and as they can do with FX and everything else. But with bonds, that's much more difficult because of all of those other factors. Have I missed anything to your mind?
I don't think you have, but you've put the fundamental aspects that, and I think you'll all agree, we saw it in the crisis, the COVID crisis. Someone could quote you a bond at 84 cents to the dollar, someone else in the next minute at 94, right? And private bank clients do buy at least 30 to 40% of their portfolio is in bonds. Then one of the things I hear, and I want to, Adam, maybe stay with you and ask you, are funds the solution? Shall we just, unlike equities where people can buy single stock and funds, shall we just tell retail that just buy funds? Is it the same? Is it a direct substitute? Or do you think that you need both to independently exist?
So I think it depends on what your objective is. If your objective is a, as it were, quasi-perpetual investment into something that will give you a stream of income, then I think a fund, why not? However, certainly many of the investors I see are interested in buying an instrument that will give them a certain return of their certain, in inverted commas, I'm talking from the investor's point of view, assuming they're happy with the credit, that will return their capital at the end of a fixed period of time and will give them a yield through that period of time. Now, obviously, the problem that you may find with a fund is that through time, if rates rise, then you may find the NAV dips, and despite the fact that maybe your yield is increasing or your income is increasing, that certainty of that receiving the money at that point or a specific point in the future isn't necessarily there. And I think this is why you've seen the quite significant increase in fixed maturity type products, which are effectively trying to give investors a diversified bond exposure, but respecting that idea that investors would like to have their capital back on a particular date. And there can be lots of very practical reasons why people might want their money back on a specific date. They may be saving for an occasion or education or any manner of things or any number of things. So look, there's space for managed investments, there's space for direct investment, and I think that what we're talking about here is what is the potential for making direct investment more accessible to investors who are operating with a smaller amount of capital.
Thanks. Yeah, Oi.
Well, if I may be slightly so provocative around this, look at the equity markets, right? I mean, I think the revolution that was 40 years ago, which was, guess what, electronic trading, right? Scriptless shares, that has created a massive democratization of equity investing. And in that market, you have equally the amount of funds and the direct access, as well as ETFs. Right now, you can choose passive, active. So I don't think I think that technology and the lack thereof is actually prohibiting or preventing the democratization of bond investing. And I don't understand why. You can walk in and open an account with FTX or Kraken and buy some crypto, but you can't actually do that with bonds. I think that is very interesting.
That's a very good point, by the way, I think. Excellent.
I couldn't agree with you more, right? There is not that much risk for me to buy one of the national champions, their bonds, and if in Asia you try and buy Tesla's bonds, it's almost impossible. You can buy their stocks, right? Anyone can sell you Tesla stock, but to buy Tesla bond, which I, at that point in time felt was not bad, it's impossible. It's not hard. It's impossible. Rajiv, you want to say something?
Yeah, so it's sort of one begets another, right? So you have a cold start problem, right? So you need retail for innovation and you need innovation for retail, and then we are basically spinning wheels without moving. If you look at equities market were also not a small ticket. You had lot sizes in equities if you go back 20 years ago, right? Till recently on the Singapore exchange, the lot size was 1,000 shares, right? So they came down to 100 a couple of years back. But in a lot more markets, the lot size is 1. And on top of it, in the US, you can go out, every broker offer you a fractional share. So you don't need to invest $1,000 for buying Tesla. You can already buy 1/10 of Tesla. So there's nothing stopping, I think, us or a platform to sort of go there. It is simply one waiting for another. So we are in the chicken and egg problem.
Okay, how are you solving that problem, Mohit?
Well,
give us an option.
I actually think the problem is far deeper than that also, partly because the incumbent infrastructure is actually extremely inefficient by itself, right? If you think about a bond and the institutional bond, the minimum size of any benchmark bond is in the hundreds of millions. Why? Because the marginal cost of doing a bond is a lot, right? You've got pay the trustee, you've got to do a paying agent, you've got a settlement agent, you've got to, and all that routes through Euroclear and Clearstream sort of all over the place. And it's very, very hard to sort of break through that incumbent system. What we found, interestingly, is we came from the retail route, well, high net worth, but individuals, was that when we started the platform, we had some issuers who came to us and said, well, we see your platform as a great place to look for smaller size fixed income issuance, right? And a few of them launched what we call commercial paper, which are 3-month rolling bonds, if you will, and they pay a coupon of, let's say, 1 to 2%. What we found on our platform is actually the high net worth individuals love that concept because the fixed deposits they were getting from the banks were at 50 bips. And here was CGS CIMB offering 1+%, right? So they're like, well, it's a name I know very well. It's 3 months, it's low risk, I'll do it. And so it actually became one of the most popular products on our platform. And where issuers like that was, even though they weren't doing the 100 million, 200 million, they saw the ease of the speed to market, how quickly they could get their money in and out. We basically built FinTech to allow rollover, redemption, new investments at clicks of buttons, and the issuer immediately knew whether they needed to pay up or take or they get more money back. So I think it presents actually a mini case study of what a digitized bond market might actually look like in the future. I think similar to what Rajiv is doing with SGX at Market Node. I think that's where hopefully this will bring about the fractionalization capabilities that even Rahul and ourselves have been working on.
I saw something pop up. There was a comment I saw on the screen from a gentleman called Danny Sethi, who's saying, why not put everything onto an exchange? Why does bonds need to be OTC? Right? Because equities, because they are all trade on the same venue, you get a trade print. To Adam's point, you know exactly what this price discovery is, you know what how much volume traded, and everyone can line people up into a central limit order book and makes it more efficient. No? Then retail and institutional can drink from the same cup at the same price, right? Do you think that's possible?
Huh? Everything is possible, right, Rahul? Everything is possible, right? So
what's the word from the boiler room?
It's impossible. But again, we will go back all the time, right? So who is basically putting the spark, right? So who is the exchange that basically bringing that accessibility in? And as we discussed, right, bond market has always been largely institutionalized, and that means that they're used to doing certain things in a certain way. So the longer you do a certain thing in a certain way, the more inertia there is to change, the more resist, and that's where that means you have to light bigger fires to actually move that.
Now that's Rajiv's revision of Newton's law. The longer a body has been at motion or rest, the longer it will take to change. I actually like it. You should, you should carry on with that. So that's it. So Singapore, has a lot of innovation that's going on. But I want to ask a question on settlement risk, right?
Actually, can I just before we move on to this, can I mention one point that I think probably limits the ease of putting bonds onto the exchange, which is the fact that with limited issue sizes and therefore limited liquidity within each issue potentially, then it would be more difficult for you to get market makers in place. And when you don't have market makers, then you end up with a more difficult, kind of situation of maintaining liquidity for investors. And if you don't have liquidity for investors, then potentially, people are not as interested in actually looking at the exchange and buying them on the exchange. I mean, the similarity that I would draw would be between that and the quite large number of ETFs that have been launched over the years that have never managed to gain critical mass, and many of them have eventually been delisted.
I personally think liquidity is, again, it's chicken and egg. It is completely chicken and egg. I actually think that if there is a fractionalization part of that, if there are more participants and it's a global participation, so you're like basically, well, again, crypto world 24 hours, I think you will see that. And once you see the retail and the flows, the market makers will come, right? Or, the market makers can just, throw in something at, 10% discount. I mean, who knows, right? And just buy up whatever is out there. So I mean, we see that because as a new exchange, we sort of think about that market making and liquidity all the time. And we have underlying funds that are illiquid. But we think that with the increased participation, whether it's members or participants, we see financial institutions start to think very hard about how do they market make on even a small exchange like ourselves. So I think it's a matter of time.
I can also...
there's one other point that I would raise, which is that in order to have trading on an exchange, the holders of the securities need to want to trade the securities. And the biggest difference between equities and bonds is that a large portion, certainly once you came down to individual investors, a large portion of individual investors actually want to hold to maturity. And so while you might then get interest coming at the beginning, you may find that actually your effective free float on the exchange would be so small that liquidity might be difficult.
I think that's a good point, and I want to elaborate that point, Adam. So there are 8 million bonds in the world, right? That's the number of QSIPs or ISINs. And I feel that we can make maybe the top 500 issuances or issuers quite liquid. Right? Let's look at equities. The most liquid is the Dow 30 or the S&P 500, right? That's still only 550 names. Look at all the major regional exchanges you get. So I think those 8 million bonds will never be liquid. Some of them will never trade. But a bond like, let's say, the Kingdom of Saudi Arabia, $10 billion issuance, and Mother, I'm sure you can rattle off, some very large issuers. We have HSBC, your issuances, or, which is one of the most popular bonds. So I think the use case of making those liquid can obviate some, not all of Adam's problems. Because I agree, people are not trading fixed income as much. And that comes down to the 1% bid offer that a retail person pays. So if equities were trading at 1% bid offer, people would also do. So I think there is some amount of virtuosity that you need. But let's look at the future. You know, we spent half of our 45 minutes weeping about the past, right? Now, how can we change? Go with you. Tell us what's MarketNode and what are you doing there?
So again, right, when you sort of look at the digitization of capital markets, especially if you look at the bonds, right, the post-trade piece is almost the same, right? So equities or fixed income it doesn't matter, right? It's the same pipes. Yeah, the roles are slightly different. The expertise is even more, nuanced, but the backend pipes are the same. So if you can do equities a certain level of efficiency, you should be able to do, in theory at least, with the same amount of efficiency for fixed income. The front end bit is where I think, can you do much smaller issuances more frequently without paying a lot of fees? That's where the innovation is also possible, right? So now, the way we are working with MarketNode is, can we sort of combine these two pieces together and sort of bring the issuance and also the post-trade infrastructure together? It is also about trying to solve that cold start problem, right? So you go to issuers or investors and everyone's waiting for each other. You need to have a neutral party out there, and that's another way of trying to solve that problem in the ecosystem, right? So let a neutral party try to bring together the infrastructure, and then let the participants sort of innovate on top of it. And that's the broader direction, I think, that we are taking in Singapore with MarketNode.
You're doing some cool stuff on DLT and funds, and do you find it a better world than our old?
Well, interestingly, when we built the platform, actually the easiest one to build for was credit, right? Was bonds, because I mean, it's like you said, the post trade is actually much simpler than a lot of other things. But we found a very interesting space in the fund space, right? The PE funds, VC funds, private REITs. And part of that was there is not even an incumbent infrastructure. There's actually no infrastructure, pretty much zero infrastructure for that. Because if you think about the big funds of the world, who are they serving? Sovereign wealth funds, insurance, pension funds, and they were large ticket sizes. So if you were, let's say, a big GP, and you had a distribution team, you're really just managing a smaller number of tickets, but large amounts. And so there's been nothing to build for the smallest guy. And, if you were maybe a UBS private banking client, if you were so fortunate to be that client, you would maybe see hedge fund offerings 1 million minimum, right? So for everybody who's sort of 20 million net worth and below, you actually didn't see that much. So what we saw was that we then built our tech. So we built closed-end funds, we built open-ended funds. We now sort of have capability for redemption and monthly subscription. You have seen, we just recently even did a crypto fund. But what I think was important was that we kind of looked at that space, and our investor base that have come on are extremely happy because we've now provided access to that. And we didn't have to fight against an incumbent infrastructure that was old and archaic and heavy and difficult to navigate. But what we also saw was that, it's actually post that, you look at it, actually it's exposing a lot of the inefficiencies in the bond market, which issuers have then now come to us. We're trying to, figure out how to work with, different players to make that bond ecosystem a lot more deeper and more robust, because we do see that opportunity set there. And I think, it will be a very interesting space for everyone.
I think so. But you said something, and I want to pick, because that came in your first answer, Rajiv. You said that, people don't like to invest $1 million in a hedge fund, and they want fractionalization, right? You said if we reduce the lot size, it becomes better. Every equity CFO does that. He does a stock split so that it becomes fractional by itself, right? Adam, want to bring you in. Do you see, as the head of capital markets, Citi Private Bank, do you see that people want increasing composability, more customization, and fractionalization is the way to go? What are you seeing at the top of the house?
So I do think that there clearly is a need for clients to be able to put together portfolios, diversified portfolios of single line fixed income, without having to put, $200,000 into each bond. I think that, if we can get to a system that can do that efficiently, then, I think there's an enormous amount of value in that. We do see clients, we see interest in various structures that effectively replicate that. But then, if you do a series of issues of, baskets of bonds, that means the investor has to like the bonds that are in the basket. Or if you do an index, then the client has to like the bonds that are in the index. Being able to offer, effectively an infinite variety of different combinations for clients fits in with the model that we run, which is very bespoke.
Thanks, thanks, Adam. Rajiv, do you your views on composability and this? What are you seeing? What do you think is the future?
So fractionalization, right, is again, it's infrastructure. So it's simply infrastructure. And like when the smartphones came, smartphone is an infrastructure, right? You never thought Uber was possible in 2008. But as the infrastructure improves, innovative applications come. To me, composability is one of those innovations that comes.
I'll pause you here. What is composability is in music? What is composability?
So let's say composability is basically bringing different. It's almost like a set, right? A mathematical set. So you are trying to collect different types of fixed income assets, right? In this case, right? You can also mix other kind of assets, but let's say because we're talking about bonds, you can sort of now create fixed income portfolios of a certain type, right? So, we were talking the other day and you said Asian bank perpetuals. That's a, all the names and you can create, and maybe there is a fractionalized bonds of these Asian banks at $5,000 each, and at 25,000 now I can own a bond perpetuals portfolio of Asian banks. That's possible. Now that is the basic innovation that we have now created just between the three of us sitting here, and your platform has that feature. I mean, you are creating the infrastructure for that particular
Actually,
feature.
it's live with Crystal.ai starting today.
Okay.
You can actually buy that. Yeah.
So, and now on top of that, right? So even that perpetual can become infrastructure for the next layer, right? So that's what digitization brings.
And I think what Adam is saying is that someone may not like the 10 that we pick. And I think what Adam, if I can visualize what you're saying 100 bonds on this side, let the investor or his advisor or his RM pick the 10 on the right hand side, and that is his basket.
Yeah. So again, right? So
it's like make your own pizza.
So buy your own asset, right? Or make your own asset, right? So, but again, right? So this is also the next generation ETF, right? That's what I would call it, is direct indexing. Instead of buying an index that's made for everybody else, there's definitely an index. And then you are saying, Rahul, what don't you like from this particular index? Or your financial advisor says, hey, you work already at HSBC, so why do you want to have exposure to HSBC? Let's basically remove HSBC from the bank index and then buy the rest of the banks, right? Or, some kind of a personalization. And again, we were referring that to personalization, customization. How can you do that at a scale that is vast? Mass personalization, right? Otherwise, and this fractionalization and everything that is digital, is basically pushing us towards that.
I have 7 minutes. I know you want to say something, but I want to also get the audience both in the room and on the chat. So do send in your questions on the chat. We'll look at them, pick a few. Also, I ask the people here, and I will, Marcus, come and ask you, do you want to buy single name bonds for $1,000? Because you've been nodding very vigorously. But Oi, come on you, please.
No, I'll just do a quick one. I mean, just outside of bonds, right? I mean, we're multi-asset, right? So if you look at our app and all of that, and what we see is that, let's say you had 10 million of investable assets. You're really looking at 20% of that in private markets. You're not going to allocate in a single bond.
Me cry. Can you give your examples? If I have $10,000,
right.
the 10 million examples are like.
All right. If you had, 5 million to invest, right? 1 million of that is going to be in bonds, 1 million of that is going to be private markets, maybe, you know, the rest of it across different things. But on our platform, what we're seeing is that the composability across multi-assets, right? Because then everybody can express themselves, whether it's, oh, this crypto fund is really interesting. I don't know how to do crypto myself. Maybe I should, you know, allocate 20,000 to this manager, right? Oh, you know, I see this Chinese VC fund investing in electrification and decarbonization of vehicles in China. Okay, I'll think about putting, you know, 30,000 with this guy. And suddenly he has a portfolio that's diversified and expresses his interest, not just about bonds, but also about PE funds, and also about growth, and also about impact, and also about crypto. And I think, you know, that's the bond space, again, is a representation of that as well.
Thank you for that. I wish we all have $10 million, right?
We'll get there.
Any questions from the room? Marcus, I had asked you a question. Do you want to buy bonds? Marcus is the CEO and the host for Bridge Plus. Yes. Okay. Marcus is sold on this vision of buying single name bonds. I see this number tick up on the chat. Giselle, Kelda, can we open the chat, see what the questions are, if any? In the chat, yeah.
So there's a question here. If treasuries can trade at a minimum lot size of 10K, why not bonds?
Okay. And then, oh, no, there was another one. Yeah. Okay. Let's answer that. I'll have to get up.
Treasury.
Right. Okay. Difference on our, okay. In Turkey bands with, yeah. Hey, look, people are saying that you can buy bonds in small lot sizes, right? So why can't we all buy corporate bonds? Minchi, I got the questions, right? So going back, right? I think there is demand, but there is some infrastructural issues. I know historically what the reason was. You know, coupons used to come stapled in a check for $200. So if someone bought a bond, to me the dream is, you know, 1 baht, 1 bond, 1 rupee, 1 baht, 1 Sing dollar, 1 bond, and then you'll get 3 cents of coupon, which traditional payment systems found hard to settle and give. So these things like CBDC, electronification, actually, I think will improve the payment layer so that, you know, money can move faster. Right today, if I get a $1 coupon into my US dollar account, and then I send it back, my bank will charge me $35. So I'll get minus 34. So that was one of the reasons, but I think those reasons are going away. Anything else, Rajiv or Adam? Any structural reason why bonds should not or cannot trade in smaller lot sizes?
So one of the other things that we will see is, you know, getting these settlement cycles, or when you buy, how soon can you basically get the ownership of, right? So traditionally the markets have always worked on T+2 and T+5. And for new generation of investors, right? So who order something on an online platform and actually get that physical object in 2 hours, you know, Lazada or Amazon, they are very surprised. Why does my electronic good, right? Bond is an electronic good. End of day, you're not getting physical checks and staples anyway. Does it take 2 days? So the platforms that we are working with should, I think the markets are going that direction, but instant settlement also reduces the risk.
A good point. And I think the point is that Amazon can deliver me young ginger, old ginger, middle-aged ginger within 2 hours on my doorstep, a physical good, right? Why does bond take? But Adam, is settlement risk a big problem? Do you see that? That's not a big issue. We don't really need to focus.
No, I don't think so. I mean, I completely agree with that point about the speed of settlement. And I think that, you know, anything that people, you know, buy now needs to be delivered slightly sooner than in 2 days' time. But I guess, you know, one point that I was going to make, though, if I might just change the subject slightly, is something that also is facilitated by you know, making all of this digital, is firstly the advice in terms of, you know, being able to use the profile of an investor, the information you have about an investor, to then guide the investor towards things that may be interesting and or suitable for that investor. And then the other thing is the post-sales service, because unlike equities, which you can effectively put into an account and theoretically they can be there per kind of Buffett forever, your bond is going to mature. And so if you do have a portfolio of a large number of bonds, then you're likely to have a constant stream of maturities that therefore then need to be dealt with. And if you're going to make that a successful portfolio, you need to roll over, obviously fairly consistently, all those types of things. And I think there's a huge opportunity for technology to make that process significantly more efficient, and therefore assist investors in making sure that they're actually maximizing the yield on the capital that's invested in that bond portfolio.
I totally agree. And I don't think, Adam, that part is non-controversial. We need technology to stop charging $10 for every coupon payment, 2 days for this, 5 days for that, and the rollover risk. Mother, I'll come back to you with the question. Oi, please.
But the technology already exists, right?
Rajiv, does it or does it not?
It does exist.
And will you share it with us or not?
Every day.
Right? None of us see your technology. But so you're saying we can solve all these problems?
Yeah, technology is always the enabler, right? So it's always been there, and I don't think we need fancier technologies than what already exists, right? So
yeah,
definitely fancier technologies will come through, but it is more a question of adoption and adoption at scale.
We're running out of time, but I think we'll extend for a minute, please, Zoe. And then there's a very interesting question that maybe explains why technology exists but is not being used. Please.
Just a very simple point around blockchain and smart contracts is completely disrupting this space, right? If you think about, we use tokenization. Settlement is DVP, it's instantaneous. Coupons are paid immediately because the smart contract is immediately calculating what coupon is owed to you and minting a fiat token. You see that token immediately in your balance, right? In your e-wallet. So it exists. I think it's, again, just how scalable and penetratable into the incumbent system that then it will really work.
Madhur, do introduce yourself.
Hey guys, I'm Madhur. Rahul and I used to work together. I'm ex-JP Morgan and Standard Chartered. I run my own thing now. To your point much earlier on the 250K minimum denom, some of the markets have sorted it out. I remember doing an Aussie bond some time back, maybe 5 years ago, where the minimum denom was 2K. And I think, if I'm not mistaken, it was listed in the West, somewhere in the London Stock Exchange, I think. So I think denoms are coming down, and I think that can help the retail participation a lot. To your point, Rahul, where you said 8 million bonds in the world and 500 issuers, why don't we allow them? I think you can, frankly, and it really boils down to the disclosure aspect. It's easier in the US with the 10Ks and the 10Qs and the 20Fs. But I think it's much more difficult when there's not continuous disclosure. In Australia, there's continuous disclosure, and the onus and the liability is on the issuer to make sure that that's continuous disclosure taking place via the stock exchange. So it makes it a lot more easy. And on the analyst side, you obviously have tons of equity analysts all around the world and floating around on Yahoo Finance and whatever else. But I think on the bond market side, that analyst is really missing, and they really become a part of a trade desk or a Fidelity or one of the large bond portfolio managers where the analyst is actually helping a trader. So I think that ecological system for the development of this, the tech is there, but I think the ecological system is a little wider. And once that ecological system and the value chain is kind of sorted out from one end to the other, I think you'll find boatload of participation coming in from the retail guys, and like an IBKR platform or a Thinkorswim platform, which is available for the equity side. If that kind of moves into the bond side, much easier for somebody to just click, and like Rahul, you said, use your phone, click. Right? Much easier that.
So I think great points. And Madhur, I think continuous disclosure is important. Let me just start to wind up with one last question that I ask everyone. And the question is very simple. For your clients, all three of you run consumer-facing businesses. In how many years months or weeks, or maybe it's live today, can clients buy $1,000 bonds of, let's say, the top 100 issuers on their phone? Question is on their mobile phone, right? That's what Mother said. That's what a lot of people are saying. When will your apps compete with Amazon?
Well, we have in a limited way. We
Okay.
do have.
How many
you can-
bonds?
Not many. For
Okay.
now, because we do the issuing ourselves. So
Okay. So, but in how
We
many
do.
years, weeks, months,
oh,
500 bonds on the phone, one click to buy?
I don't think it'll take that long. It'll be less than a decade. It'll be less than 5 years.
For you, within 5 years, you'll, Rajiv?
Yeah, somewhere between 2 to 5 years, right? You can't
2 to
be
5
still.
years?
2 to 5 years, I think you will see, because especially in this part of the world, more and more people are coming into this segment of the economy
Yeah.
where they will have discretionary income to invest. And there's definitely going to be some amount of money that will be allocated to low risk investments, right? So this,
Yeah.
there is going to be demand, and the platforms, and we are also looking at a lot of platforms. So I think it's the next 2 to 5 year time frame.
Adam, that goal of being able to buy single line bonds on the phone, how long do you think it becomes till it becomes as common as Amazon or Uber apps?
I want it yesterday.
Excellent. On that final note, thank you very much. Great panel. Sorry we overran, and look forward to seeing you all at the next FinTech Festival. Bye-bye.
Thanks, Rahul.